Liquidity. It's a word repeated daily in financial news. Markets need liquidity. Central banks provide liquidity. Liquidity supports stability. But what if liquidity is not as solid as it appears? What if the modern financial system is not stable because it is strong, but because it is constantly being supported? Liquidity is the ability to buy or sell an asset without dramatically moving its price. In theory, deep markets mean resilience. In practice, liquidity can disappear faster than confidence. The global financial system today rests on an assumption that there will always be a buyer, that there will always be funding, that there will always be access to capital. But history tells a different story. In 2008, liquidity vanished. Banks stopped trusting each other. Short-term funding markets froze. Assets that once traded smoothly became impossible to price. It wasn't just insolvency that threatened the system. It was illiquidity. Because in modern finance, liquidity is oxygen. Without it, even healthy institutions suffocate. Over the past 2 decades, markets have evolved. Passive investing dominates flows. Exchange-traded funds promise instant liquidity even when underlying assets are illiquid. Corporate debt markets have expanded dramatically. Private credit has grown in the shadows. Derivatives amplify exposure. Everything appears tradable. Everything appears fluid. But liquidity is not the same as value, and it is not permanent. Consider bond markets. For years, low interest rates encouraged companies to borrow cheaply. Investors hungry for yield poured capital into corporate debt. Prices rose. Volatility remained low. But bond markets depend on dealers to provide market-making services. And after regulatory changes post-2008, banks reduced their inventory of bonds. This means that in times of stress, there are fewer shock absorbers. If everyone wants to sell at once, who buys? Consider exchange-traded funds. ETFs promise instant entry and exit. But many hold assets that trade infrequently: corporate bonds, emerging market securities, complex derivatives. The ETF structure works smoothly in calm markets, but in panic conditions, liquidity at the surface can mask fragility underneath. The illusion is not that markets are fake. The illusion is that liquidity is guaranteed. Central banks understand this risk. That is why, in crises, they intervene not just to lower rates, but to inject liquidity directly. They buy bonds, they expand balance sheets, they open emergency facilities, they become the buyer of last resort. In doing so, they reinforce confidence. But they also reshape incentives. If markets believe liquidity will always be provided, risk-taking increases, leverage grows, asset prices inflate, and the system becomes dependent on intervention. This is the liquidity paradox. The more authorities stabilize markets, the more markets rely on stabilization. The stronger the safety net appears, the thinner the underlying structure becomes. Look at March 2020. When the pandemic shock hit global markets, liquidity evaporated almost instantly. Even US Treasury markets, considered the deepest and safest in the world, experienced severe dysfunction. Bid-ask spreads widened dramatically. Funding markets tightened. It was not a solvency crisis. It was a liquidity crisis. And within weeks, central banks unleashed unprecedented interventions. trillions of dollars in asset purchases, emergency lending programs, corporate bond buying. Liquidity was restored, markets rebounded. But the lesson remained. Without intervention, modern markets can freeze. Why? Because liquidity today is built on leverage. Hedge funds borrow to amplify positions. Banks rely on short-term funding. Corporations refinance debt continuously. Governments roll over bonds regularly. The system works as long as funding flows. But funding flows because participants believe it will continue flowing. Confidence creates liquidity. Liquidity reinforces confidence. It is a feedback loop. And like all feedback loops, it can reverse. Technology has added speed to fragility. High-frequency trading provides constant bids and offers until volatility spikes. Then algorithms withdraw. Liquidity disappears in milliseconds. Flash crashes reveal how thin markets can become. The structure appears deep, but depth can be conditional. Private markets add another layer. Private equity, private credit, venture capital. These assets are marked infrequently. They appear stable, but stability may simply reflect delayed price discovery. Liquidity there is limited by design. Yet investors treat valuations as real-time reflections of strength. Again, an illusion of smoothness. The global economy depends on liquidity not only in financial markets, but in trade finance, currency swaps, and interbank lending. If dollar funding tightens globally, emerging markets feel pressure immediately. Currencies weaken. Capital flees. Debt becomes harder to service. Liquidity is global, and fragility travels quickly. This does not mean collapse is inevitable. It means the system is optimized for growth, not contraction. It is built for expansion, not retreat. And expansion requires liquidity. When expansion slows, authorities respond. Rates are cut. Facilities are opened. Balance sheets expand. Liquidity is restored. Each cycle becomes larger than the last. The question is not whether liquidity exists. It does. The question is whether it is structural or supported. In a world of high debt, engineered markets, and layered ownership structures, liquidity becomes the glue holding everything together. But glue can dry. It can crack. It can fail under pressure. The liquidity illusion is not that markets are fraudulent. It is that stability feels permanent, that buyers always exist, that exits are always available. History suggests otherwise. Markets do not collapse because assets lose all value. They collapse because liquidity disappears. Understanding liquidity means understanding fragility. And understanding fragility means recognizing that confidence is the ultimate asset. Because when confidence fades, liquidity follows. And when liquidity disappears, the system reveals its true structure, not stable, not permanent, but dependent on trust, on policy, on intervention. Liquidity is powerful. It fuels growth. It enables prosperity. But it is not infinite. And the illusion that it is may be the most dangerous assumption in modern finance. Welcome to Cash and Chronicles, where money, power, and history collide.